Okay, part 2 of chapter 3 lecture videos. So, the next section of prepaid expenses or deferred expenses is called depreciation. So it's a special category of the prepaids, and with this one we have what we call long-term tangible assets that we use to produce either a product or might use it to provide a service. So they're called plant assets. They provide benefits for more than one period, and some examples would be like a building, a car, machines, vehicles, fixtures in a store. And what we're going to do is we're going to expense that cost over the life of the asset or over the useful life of the asset. So that's called depreciation. That's when we're allocating the cost of the plant asset over its useful life using a specific formula. This point, we're going to be using the straight line formula, and later in chapter 10, we'll get into some other formulas for how to calculate depreciation. We're going to keep it simple for right now and use something called straight line depreciation. So we're going to be taking the cost minus what we call a salvage value, or what we expect it to be used, or what we expect it to be valued at the end of the period or the end of the life of the asset. So the salvage value is the amount we expect to receive for it when we dispose of it at the end of its useful life. So we're going to take that asset cost minus the salvage value divided by the useful life, so the number of years we expect it to be useful. So that's how we're going to depreciate. So when we think about that, let's go into useful life a little bit more. So useful life is when we're figuring out how long we expect this asset to be good for our company. How long is it going to help us produce revenue? So useful life expires as a result of wear and tear, or because it no longer satisfies the needs of our business. So it can be either. When we talk about salvage value, again, it's what we expect the selling price of an asset to be at the end of its useful life. It's also sometimes called scrap value or residual value. They all mean the same thing. It's what is the value when we're ready to get rid of it? What do we expect it to be worth? So let's look at an example of adjusting for depreciation. So we have Fast Forward that purchased equipment. So that's our long-term asset, our plant asset. On December 1st, they paid $26,000. It's telling us that it has an estimated useful life of 5 years, and they expect it to be worth $8,000 at the end of that 5 years. So the salvage value is going to be $8,000. So we have to break that down into what we're going to be expensing over each month. So it says it's 5 years. So 5 years is 60 months. So we're going to divide and expense every month for 60 months, the value of this. So we expect it to be worth $8,000 when the 5 years are over. So we're going to take $26,000 minus $8,000 divided by 60 months. Again, we could break it down by years first and divide it by 5, but then we have to divide it by 12 to figure out how much we're going to actually write off every month or expense every month. So you can easily just convert the years to months. So 5 years times 12 months gives us 60 months. So if we take 26,000 minus 8,000, that gives us 18,000 as the cost we're going to spread out over 60 months. So we take 18,000 divided by 60 months, and that's going to tell us how much to depreciate. So here's the formula for it. So original cost minus the salvage value gives us our net cost. So 26,000 minus 8,000 gives us that 18,000. That's what we're going to depreciate. We're going to take that 18,000. Again, we're spreading it out over 5 years, and we want a monthly amount. So 18,000 divided by 60 months gives us $300 per month that we're going to expense. So every month we're going to expense $300 of depreciation for that piece of equipment. So our next one, step 3, is to record the adjusting entry. The nice thing for depreciation is the entry is the same every single time. So you always are going to debit depreciation expense. You're always going to credit accumulated depreciation. Accumulated depreciation is exactly that. It's what we call a contra account. So it's called a contra asset account. So that means it has the opposite normal balances as an asset account. but it is a type, it's a contra asset, so it just contra just means opposite, so opposite balances, but it's going to accumulate the amount that we depreciate over the life of the asset. So we're going to be able to look at accumulated depreciation at any point in time and see how much we have depreciated total. Each month we're going to be depreciating $300. So we're going to debit depreciation expense and credit accumulated depreciation. So this is what our entry is going to look like for every time we do depreciation expense. We're going to debit depreciation expense. We're going to credit accumulated depreciation for equipment. Sometimes you're going to see that accumulated broken down into specific assets. Sometimes you may just see it just as accumulated depreciation. It will be clear and connect which one you need to choose. So again, remember, accumulated depreciation is a contra asset account. That's the first time we've seen a contra account, but it's not going to be the last time we're going to see it again. So again, just for your information, a contra account is an account that's linked with another account, and it has the opposite normal balance. So it's reported as a subtraction from that other account's balance. So in our case, accumulated depreciation will reduce that asset account equipment. Because it's a new type of account, let's look at the treatment of the contra and related asset account on the balance sheet. So we can see here that we have equipment that's $26,000. We have depreciation expense that we did of $300 and accumulated depreciation for equipment of $300. So if we look at how does that look on the balance sheet? Well, we're going to list equipment minus or less accumulated depreciation, and we're going to see that net value or the book value of that asset. So that contra account accumulates the depreciation, and it's a reduction to the cost of the asset, which is equipment in this case. So the cost of a plant asset less accumulated depreciation is known as our book value. So our asset, the equipment, is going to be shown on the balance sheet at its net amount or its book value. So if we look here on the slide, we have a partial balance sheet. It's just showing you that we had, in this case, it's 3 months of depreciation have been taken on the equipment. So 3 times 300, or a total of $900 total, is an accumulated depreciation at the end of February, month 3. So the equipment account is being reported at $25,100, which is the cost that has not yet been depreciated. Because the contra asset appears on the balance sheet, it's not going to be closed at the end of the period. It will be carried forward to 2021 and used to accumulate depreciation related to that equipment for the life of the asset. All right, that closes out our deferred expenses. Now we're going to be looking at what we call deferred revenues. So we have our first slide that shows us that unearned revenue is cash that we received in advance for providing products or services. We've seen that account before. That one's not new. So in that, we are debiting a liability account. The liability is your unearned revenue, right? We had unearned. That was a liability account. So to adjust it at the end of the period, when we've actually recognized that revenue and earned it, we're going to debit unearned, that liability account, and we're going to be crediting a revenue account, depending on what revenue we've earned. So let's look at an example. So it says here that Fast Forward's client paid 60-day fee in advance covering the period 12/27 to 2/24. When that happened, we received cash of $3,000, so we debited cash and we credited unearned consulting revenue, that liability. Then, now we have passed some time and we've earned payment for some of that time because we've completed that job. So at 12/31, we have 5 days of service that has been earned. So we want to recognize that at the end of the period to adjust for where we are at the end of that time. So 5 days out of a total 60 days because they paid 60-day fee in advance. So we've earned 5 of those 60 days. So if we take 5 divided by 60 times $3,000 that we got up front, that means we've earned $250. So we're going to do an adjusting entry that reduces the liability unearned consulting revenue by $250. And we're going to recognize earned consulting revenue. So that's what we're going to see here. We are debiting unearned consulting revenue to reduce the amount that is unearned because now we have earned that amount. And then we're going to credit consulting revenue. So our balance sheet's going to show $2,750 of unearned consulting revenue is still unearned, and the income statement's now going to show that we've earned a total of $6,050 in consulting revenue. The adjusting entry itself is going to look like this. Again, debits are on the left, credits are on the right. We list the debit to the liability, the credit to the revenue. Again, refer back to the handouts that are provided in Chapter 3 resources. There is an adjusting cheat sheet provided to help you with your adjusting entries as you go through until you learn them. All right, our next kind is accrued expenses. So this is where we have costs that are incurred, but they're unpaid and unrecorded. So we know we just got a bill, we haven't recorded it yet, but it's also not time to pay it. So what we do here is we're going to set up an expense, debit an expense, and we're going to create a liability because we're going to pay it sometime in the future. So in any accrued expenses, we're going to be debiting some kind of expense account and crediting some kind of liability account. All right, so our example, the first one, it says that we're adjusting for accrued salaries. So fast forward to paying their employees $70 per day or $350 for a 5-day work week. Salaries are paid every 2 weeks on a Friday. So we get to the end of the month in December, 12/31, and it's a Wednesday. So we have 3 days, Monday, Tuesday, and Wednesday, that are owed at the year end. So $70 per day times 3 days gives us a total of $210 that when we close our books December 31st, we have to adjust that for because we want to recognize the expense we have in that month because that's when they worked. We're not paying them yet because payday is not until a Friday. So until then, we're going to set up a payable. So we're going to debit an expense, that's salaries expense, and we're going to set up a salaries payable so we pay them on the due date or the pay date in this case because it's a salary. So on payday, we're going to pay them that amount. But for now, we're going to set it up as a payable. So here's what it's going to look like. We're going to be debiting salaries expense for $210. We're going to be crediting salaries payable for $210. That's going to take care of the accrual, but let's take that a step further. So we know at some point we have to pay them that money, right? So when we pay them, we're going to be paying them the payable, that's $210, plus the rest of the week that we pay for in January. So that's what we're going to see in this next one. So it says accrued expenses at the end of one period result in a cash payment for a future period. On 12/31, so at the end of December, remember we accrued salaries of $210. We had that salaries payable we set up. But on payday, which is January 9th of the next year, we are actually going to pay them. So we have to pay them that $210 plus the rest of the work that they worked. So they had 2 weeks of work, so 10 days total. 10 days times 70 is $700 total that we owe them. We've already accrued that expense for 3 of them. So we're not going to expense that 3 days again. So what you see here is that we're reducing that payable by debiting salaries payable for the 3 days times $70, that $210 that we put into salaries payable. We're clearing out the payable. We're going to pay them cash in their check. But we're not paying them for just those 3 days. We're paying them for 10 days. So we have 7 days in January that we have to pay them for. So we need to recognize that expense. So we have 7 days times 70, which comes out to $490. If you add $490 to the $210, that's the total that we are going to be paying out. So we're debiting salaries payable, we're debiting salaries expense, and we're crediting cash. So we have 2 debits and 1 credit. That is possible. We just have to have at least one debit, at least 1 credit. Here we have 2 debits and 1 credit, but you can see that they equal. So that's the thing. Debits have to equal credits. So our debit equals 700, our total credits equal 700. So we're okay. So just this is a combined entry where we have 2 debits. So we were clearing out that payable that we owed them. We set it up to pay before, and then we're expensing the rest of what we owe them because we're actually going to pay them because it's payday. All right, we're going to continue in the next video to look at accrued revenues.